Welcome back to the show, everyone. It has been a tumultuous week. We're going to get into some of the feistiness that took place in Davos. There was a little bit of contention amongst the ranks, if you will. We referenced it on the previous live and on podcast episode 319, which you will hear on Tuesday next week. But suffice it to say, your boy Jamie Dimon came into Davos with a very, very open perspective on how he felt about everything. We're going to use today's show to look at what happened this week. We're going to look at what we expect to happen next week. We're going to look at some of the charts that's going to get an overall broad perspective on the markets, not only housing affordability, synthetic volatility index, our market status charts, all the stuff you know and love. And we're certainly going to look at the calendar for next week, the Fed meeting probably being the most obvious thing, the low-hanging fruit that's out there. And then we're going to spend some time on social media looking at some of the things that have been posted. I think most of the noise in the market today is about TikTok being purchased in large part by US companies. And there's a little bit of ambiguity as to what the algorithm at TikTok will look like now. You got all eyes on a little bit of the weather and how it might affect the airlines from a financial perspective. There's being ice and snow in the Midwest that could prove to shut down a little bit of the airline travel over the weekend. It's going to be a rough weekend for those of you out there. I've got family and friends in Oklahoma and Texas, so I get it. And we also have some interesting things coming up as it relates to earnings of some companies that we can talk a little bit about towards the show as we get a little later in. But let's go straight to the status of the markets. As you know, bringing up our U.S. Market risk profile. And you're not reading that wrong. We've got a very different market here, okay? We are now in a liquidation forced selling set of circumstances. The day certainly started off a little bit of mix, almost defensive. And then we saw it jump into this liquidation force selling position. And this is highlighting exactly how this chart is supposed to work. As a guy who worked with our team here to put this together, I'm very proud of the optics of what this looks like. What up, Saied in the chat? How you doing, brother? I haven't checked everybody on Instagram, but I'll dip on over there real quick. Yo, what up, Instagram? Farshad, I see you, boo. Anyway, let's get into this chart real quick because it does tell us what the markets are doing today. Dow Industrials are down about 0.5 point. S&P is up, which is not surprising. And given that this is led by the Mag 7, NASDAQ Composite up, but the Russell 2000 is down and down meaningfully. Okay, so again, you're not seeing a tech-led rally. You're actually seeing the capital fleeting the market right now. This is a very, very interesting position, and you're seeing this kind of balance between these two. And I can actually refresh this in real time, which I'll probably do real quick just to give you another look at the chart here, just to make sure that we're catching this in real time. Let's go there. There you go, forced selling. So again, you're in an interesting market here where I think the market is saying, okay, you know what? We see the risk. We're concerned. Let's talk about why this is before we move on and look at some of the other charts, which I think is going to give you some perspective, i.e. the Fed's balance sheet. Next week, we've got a very important meeting, and let me show you where that is on the calendar. This is this week currently. Oh, what's going on here? Oh, okay, it ends this week. All right, so next week, we've got this date right here, okay? This is what we're going to talk about a whole lot right there. That's the Fed rate decision, the Fed press conference. That is going to be all about next week. And right now, for those of you wondering, 97% probability that the Fed will not cut rates, according to the Chicago Mercantile Exchange. So we are not seeing a lot of hope and optimism in the markets for rate cuts looming on the horizon. As a matter of fact, if you've been following the show for any length of time, you know that JP Morgan, who does have a bit of a contentious position with the government right now, they're getting sued for $9 billion for debanking the president. Davos has been an interesting set of circumstances. We will play some of that audio where Jamie Dimon has been very critical of world leaders and the United States president in some ways, loosely and democratic, but still critical. That being said, you've got some interesting things happening where David Kelly at JP Morgan Chase has said, not only are you not going to get a rate cut this year, but in 2027, when you see your first rate activity, it will actually be a rate increase. So that's going to be a very, very big different position. So I think if you saw a rate cut on the horizon, you would see a very different landscape in the markets on this chart, and that's definitely a different perspective. Let's go to the synthetic volatility index. It's going to layer on to give you a composite view of the markets. This is our synthetic volatility index, and you'll see that there actually has a calm market despite the fact that you're seeing this risk off presentation in this previous chart here. Capital's fleeting, money is bleeding out of the market, and I'll show you where that shows up in a minute. But for right now, the overall risk profile of the market is calm. Realized volatility in the day is a little bit abnormal at 79, but again, this puts you in a normal range. You're just not in this super calm perspective. But when you look at it in the context of intraday range stress, gap risk, cross market volatility, you get a synthetic volatility score of 86. I apologize, and that is well within the calm dynamic here. That's right there. And that tells you that the market is not freaking out. They're making strategic moves to position themselves in the market. What really gets scary is when you see this chart, the volatility index combined with this chart, the status of the market, both of them going towards the red side of the market. Because what this is basically telling you, this is risk off here, right? People are taking risk out of the market. And this is risk on this side here. People putting risk back into the market. And while I'm down here, shout out to our sponsor, Fridays. Go to joinfridays.com. Use the code HIGHER. You will support the show, and hopefully you will look and feel better as a result. I get peptides and testosterone from them. You should too. Okay, so let's go back to the synthetic volatility index. We have a calm market. We know that we have a risk-off position in the overall status of the markets. So let's look at some pretty obvious low-hanging fruit. This is where I think the market tension is coming from. We have a restrictive Fed balance sheet. The liquidity pulse index shows your Fed balance sheet here, which appears to be flush with capital, money in the Fed's balance sheet that can be used, deployed, right? Except the reverse repo line is at high usage right now. The treasury accounts are at high usage right now. So the net number, when you subtract those two, gets down to a net liquidity level of 5, which is draining the markets of liquidity. Pulling liquidity out of the markets, people go risk off. This is a normal set of circumstances. So you have a bit of a restrictive Fed liquidity balance sheet heading into a meeting where we know there is unlikely to be a change in the current Fed interest rate. You've also seen some things happening recently where you see the treasuries rising like this, the 10-year most notably. We covered that on a couple different lives and a couple different shows, but just as a general reminder, what we're talking about here is the Fed is now selling $60 billion of bonds into the market at a higher, longer duration, right? So again, looking at a chart here, if this is your 10-year product, right? And this is your 2-year bond product. Remember, bonds are government debt, right? And they're selling this and they want to push more money here in the tune of $60 billion. They got to price this higher, which pushes the 10-year treasury rate up. The reason why you price it higher is people are going to lock up their money for 10 years. They want more of an interest rate return. It's a simple concept when you break it down to its fundamental elements, but this is driving 10-year higher. And those of you who know the show and you know the details, the 10-year is your biggest proxy to mortgage rates. So that is going to drive mortgage rates up over time. And you're seeing a little bit of that in the markets. That combined with the fact that there is a general consensus with a 97% probability that there will not be a rate cut from Chicago Mercantile Exchange, some of the rhetoric we've seen from the Fed and some of the things that we know have transpired in Davos means that the market is bracing for what they think is going to be a more restrictive Fed over time. Now, the government, i.e. the executive branch, is working opposite of that by instructing Freddie, Franny, the GSEs to buy $200+ billion of mortgage backs, which will reduce rates about 25 to 35 basis points. I think you've already seen that benefit inured to the consumer in what was a rate drop prior to this rate hiking cycle. Again, year over year, I think we're still down on a rate. Matter of fact, if you go to our affordability chart here, you've got I got to check why this is not updating here. I think Q3 information's out, but ignore that for now. It's not really super relevant. I think year over year, you were somewhere in the 7% range, a little over that 1 year ago. Today, you're still below that at 6%. So we're still better than we were 1 year ago, even though you've got mortgage rates pushing up. But you're certainly not in the 5% range right now, at least not based on what I'm seeing here. Mortgage payment burden remains strained. Mortgage pressure, rate pressure remains relatively locked out. There's just too many homeowners that own too much of the mortgage market below 5%. And if mortgage rates are, in fact, on the rise back to close to where it was a year ago, that ain't going to get any better. And we do have a flush supply of real estate in the market. There is an accessible amount. There are certainly more sellers than there are buyers currently in this market, but everybody's a bit tense. Everybody's a bit on the sidelines. And if you think about it from the stuff that we've already talked about, and you look at the status of the market, and you have this being how the investor sentiment is, you can't really blame people for saying, you know what, I'm not sure I want to buy a house based on what I'm seeing here. A lot of people had expectations, and I should probably get serious with you for a minute, a little intimate. A lot of people had expectations that in Davos, you were going to see some significant benefit to affordability. The president kind of alluded to it, right? There was all these ideas, 50-year mortgage, borrowing from your 401k, and there still might be some solution that comes out from that. But we shared something a couple days ago via social media, which I will pull up again, which really underscored what we've been talking about on the show for a prolonged period of time, and that's it's not just one thing. You can have home prices come down 30, 40%. Fine. Okay, great. You can have rates come down 1%. Great. But you still need wages to go up a meaningful amount in order to get affordability into what I would call a normalized position. And without that normalized position, this solution, anything we offer up is just a near term band aid. And frankly, anything we offer up that makes homes more affordable will suck up that gap of excess supply in the market and drive prices up over time. So there really isn't a near term solution that anybody has proffered up. No disrespect to anybody in the housing pundit realm or the White House for that matter, but there isn't a solution that anybody's offered up that really comes to some type of meaningful change. Really, when you get down to it, you get a set of circumstances where the only solution might be time. An older general population that owns homes is forced to sell. Now, I don't necessarily know that will solve the problem in the next 10 years. Certainly, the next 20, it could. But is that going to drive values down? No, it might actually serve to continue to drive them up. So I don't know that I have a solution any more than anybody else does. I can just tell you that after 15, 16 years of artificial interest rate deflation, you got a long way to go to remediate that. And to that point, to that effect, my guy Saied On in the chat, sounds like this is going to be a 10 to 20 year problem. That is absolutely accurate. I think that's probably going to be what we see. I think you'll see varying degrees of change in what that looks like over time. And I think that there's going to be some really unique things. I'm 45, and I've lived through enough of these economies to see catalysts for events. And it used to be like I was like, oh man, it sucks. The internet crash that happened, and you had this whole internet tech bubble that burst. We did, and it sucked. A lot of people got hit hard with that, but it was an event. It happened, then things fixed, right? You could argue the same about the great financial crisis. A lot of people were hurt, not good for anybody. It did create investment opportunities. I'm not gonna lie or deny that, but it was an event. Synthetic mortgage-backed securities triggered frankly a worldwide impact. That impact affected real estate valuations, and that one event created a fix. I don't know, and I don't think anybody does, what a single event here that could fix this problem. You've got private credit markets, which have extended a lot of credit. That's certainly been a very topical conversation as it relates to things that could and may go wrong. You've got lots of issues in the housing market, which may or may not be restricted. It's unclear at this point in time. And you got lots of things that frankly could all coalesce into problems should they coalesce. But there is nothing that anybody's pointing to. People go, well, AI tech bubble. Okay, great. Yeah, I agree. It's in a bubble. But what's going to be the catalyst? What's going to drive this change? And I don't know that anybody has that answer. I don't know that we've seen it yet. Certainly there is a parabolic curve of efficiency that is coming off. So, I mean, obviously this is your, it does a text whenever I talk. It's cute. This is or was the idea of what AI would do efficiency wise, but that's not what it looks like. It's actually starting to look a little bit more like that, right? Except energy costs look like this. And because of this delta here, you've got massively increasing energy cost, 4x the cost of energy for about 25% of improvement. You saw Ben Affleck and Matt Damon talk about that on Joe Rogan. That is absolutely accurate. And what I would expect is the efficiency to go down over time and the cost to power the reasoning models to go up over time. At least near term, and over long term, you'll get more efficient electricity and better modeling. So as you hit this inflection point, there's going to be some interesting things that happen with AI. And we do have a conversation to have later on in this show about AI, and we're going to have a meaningful one. I think that's going to be a very important part of this dialogue. So let's go to one of my favorite presentations, the screen, our intimate setting together. And let's talk a little bit about some of the stuff that we're seeing in the AI world. I'm going to bring up YouTube. This is Google DeepMind CEO talking about AI, and I think he's a great person to kind of listen to on this particular topic. Let me bring this up here. Multitasking as per usual. And I don't know if we're going to get any ads on this, given that it's 5 minutes. We might. If not, we'll just share an intimate moment together while an ad plays. But let's see how it goes. Here, multitasking. Oh, I'm echoing a little bit. That's strange. Hold on one second. Let's see if I can fix this real quick. All right. I believe this might be this here. Let's try this again. Yeah, I fixed it. Every once in a while, I get something right. Okay, let's go.
Google's Gemini is surging in popularity. Some argue leading the pack among the large language models. Just last week, Apple announcing it picked Gemini to power Siri. Andrew sat down with Google DeepMind co-founder and CEO Demis Hassabis. I don't know if I said that right.
I don't know if you said it right either.
This week in Davos, and asked him about the evolution of Gemini in the AI tech race. Take a listen.
It's been a kind of long journey last couple of years to kind of corral together all of the assets that we have as Google and DeepMind. Incredible research bench, our TPUs, and all of the kind of research we've been doing over the last decade plus, really, that underpins a lot of the AI industry. So we always had all the ingredients, amazing product surfaces to plug AI into, and I think in the last year what people are feeling is we've kind of organized that all in a really efficient way.
Okay, so where are you in the journey, though, in terms of what comes next, about sort of productizing all of this, really getting it into all of these different surfaces? When am I going to see it in Gmail, for example?
Yeah, so look, everything starts first of all with the research and the model quality. So as you mentioned, we're very happy with how our latest Gemini model, Gemini 3, is working. We think it's, it's topping most of the leaderboards on most of the benchmarks. And the other thing we worked hard on in the last year is accelerating the infrastructure and, actually doing a lot of rewriting of the infrastructure to get the model quality as quickly as possible into our product surfaces. So you're starting to see that in, we're simultaneously shipping in search, obviously in the Gemini app, and then what you'll see this year is appearing in more and more places across all of our product surfaces, especially things like Gmail.
When people talk about getting to AGI and sort of how quickly all of this can scale, there's sort of two views. One is, if you just throw more compute processing power at this, we can get there.
Before he answers this, I want to point out, consider the timeline and implementation that he's thinking about across different parts of the existing ecosystem that we all know and love currently. And think this through under the auspice and viewpoint of how this will impact employees. You're going to see a little bit of this rhetoric come back in other places in Davos that we're going to share with you here in a minute of how and what this really, how this could change things and what this really means for all of us, frankly.
Another view that there needs to be some kind of really breakthrough scientific research shift. Which is it?
Well, actually, I have a kind of in-between view, which is that I think it's an empirical question. So I feel like we're still getting lots of amazing gains out of pushing the existing paradigms, these LLMs, these foundation models like Gemini. They're getting better and better with each iteration, and we see no end to that. But on the other hand, to get to full AGI, there's some missing capabilities still. They don't do continual learning. They don't have true creativity yet. They don't do long-term planning and reasoning. So it's a question mark about a couple more, maybe a handful, 2 or 3 new big breakthroughs needed in order to get to all the way to AGI, or will scaling up the existing techniques be enough? And we're doing both. So we have the luxury of basically having the deepest and broadest research bench, and we can push both to the maximum.
There's a big question about whether there's an AI bubble. You've heard that over and over.
So let's pause there while he's responding, and let's think this through. So we know that we haven't reached AGI, artificial general intelligence, yet. We know that there's some technological challenges, as he's shared with us, to getting there. They're certainly growing the current LLM infrastructure and they're certainly still going down the path of AGI, which, again, Google's DeepMind is not the only one doing this. They're one of many worldwide that are doing this, and power consumption continues to be the conversation and how efficient these models can be. So he's alluding to all those things and addressing it, but he seems somewhat nonchalant in his response. Now we're going to get into Andrew Ross Sorkin asking him about this bubble. And again, this is one of those things we've been very clear about on the show. There is a bubble here. The question is, are the things he just answered going to come around in a timely enough fashion to prevent this bubble from bursting? And I think the most obvious answer is that we don't know, and that if efficiency and things are kind of being a little more tepid than they had been historically, we're seeing a drop off here, which may or may not be a blip in a chart going up, or could be a permanent slowdown. This comes down to power and resources, and some of these companies have a whole hell of a lot of resources, money, and some of them are already applying for nuclear power plants, power. So they may be able to push through that incidental physical restraint to get to the other side from a technological perspective. And then guess what? You have another CapEx, this is going to change the world dialogue that's happening, and people are going to say, well, this is going to change X, Y, and Z now, even farther than we push you for. And then you have another capital expenditure layout that we really haven't even thought of yet or planned for, that's beyond the current AI infrastructural planning. Here we go.
Yes.
Is there a bubble?
Well, I don't think it's a binary yes or no. I think
it is a binary yes
now, and there's many parts to it. I think some parts of the AI field may be in a bubble. I mean, if you look at things like the new hot startups that raising billions of dollars in a seed round with no product or technology yet, that seems a little bit frothy to me and perhaps unsustainable. But on the other hand, there are lots of amazing use cases going on and products being used.
In terms of spending, people talk a lot about spending on data centers and the need for new chips.
So I want to point out that he kind of said something without saying it that I think is meaningful here. He said that these startups with technology, they don't have use cases yet that aren't earning. He basically carved out, he works for Google, and one of Google's subsidiary companies that is going to implement this across the company's framework. So for them, it does improve efficiency in theory right away if you can deploy it in a way that it does things that humans are currently doing now, either quicker or behind the scenes or at night, or some type of more efficient result. And there's lots of different ways this can happen. So they can improve efficiency based on this and have less employees doing the work, or just get more output of whatever product it's being implemented on. And great. And some of that's just as simple as improving the user experience, implementing this in Gmail, for example, in email services. That could be really interesting. Now, I don't know about you. I have a very uncomfortable position with using AI directly in my email. I like it narrowly tailored in my window where I can respond to it. As sycophantic as that may be, that sometimes you talk to it, or you consider it a person or somebody you can reference there, but you don't want it fully ingratiated in your email. And maybe that's just my older boomer privacy concerns. I don't know. I just don't like it as much in utilities like Outlook, for example, which has tried some variant of that recently. I like to use it independently where I know that I am directly and intentionally using AI, but maybe that's my personal preference. And again, we're going to go on the power side here.
You think about sort of what comes next. Do you think we could have a DeepSeek-like moment, rather, where there's some kind of major technological revolution where people say, oh, maybe we actually don't need all this processing power?
Yeah, I think it's very unlikely, and I also think the DeepSeek moment was a little bit overblown, in my opinion. Like, they had to utilize some of the Western models in order to kind of fine-tune against and to train from. So it wasn't, what they reported, this very small training number, wasn't quite the full picture. It is possible that one of, there could be a left field breakthrough that does increase the efficiency of things, maybe things like self-improvement, where you could imagine there's some cycle which requires less compute power. But for now, we think that more compute, you need compute for lots of things, for training, for serving, and for exploring new ideas. But of course, all of us are trying to make our models, our leading models, as efficient as possible. So in fact, of the Gemini 3 models, our Flash model, which is sort of the workhorse model, may be the most important because we can deploy that everywhere.
A lot of hand-wringing around here about jobs.
Mm-hmm. Yeah, and that's going to be an important part of our conversation as we go through this from a finance perspective. But one of the things I think a lot of users who use, I guess, AI as kind of an anecdotal add to their lives, I use it for writing letters or response, whatever you might use it for. I don't think a lot of people realize that there are different models even within ChatGPT. There's a more critical thinking model. There's effectively plugins you can add to them. There are ways to get deeper into AI. Claude does a great example of this. They have a very much an aggressive thinking model. They have, their normalized model for quick everyday tasks. One of them takes a lot more time to respond, but is more thorough. If you're ever struggling with AI, it's a great kind of like little switch to try to get better results. Is if you're getting results that are kind of weird, click on the higher thinking model and see if that works. Now it does, like in Claude's case in particular, where usage is tracked a little bit more vigorously than ChatGPT. If you overuse the model too much, they'll tell you you're out of usage until later in the evening, whereas ChatGPT will just effectively temper you back and slow you down. But that's one thing. But again, why are you limited on usage for the higher thinking model? It's taking more compute. More compute equals more power. And there, it's kind of this vicious cycle of underlying problems. So I do think that they've got to find a way to make this one model that does effectively everything well. Having the separate models is lost on a lot of consumers. It's just an extra button to click, and most people don't understand the nuances and the difference. And we already know that AI, as presented today, is not a very creative thinker, and certainly has a very tough time taking images and parsing intellectual responses to it. It can create from that if you give it direction, but generally speaking, it's not very creative, if you will.
Ultimately happens 10 years from now. Maybe it's 5 years from now. I don't know if you think, even when you look at employment numbers today, that to the extent that there's any softness, it's a function of AI and productivity being more successful.
Yeah, I think it's early days. I don't think there's any real evidence yet of any change in the job market.
I absolutely disagree with that. And it is in his interest to say that. So grain of salt there. The FOMC has also been echoing that. But we have pointed out multiple times on this show how AI has affected layoffs. I think we are already seeing it, and it is naive and ignorant to ignore that that is the natural, normalized byproduct of improving efficiency.
Perhaps a little bit on the entry level, maybe jobs and internships. But I think in the next 5 years at least, it's going to be more than made up for with extraordinary new opportunities these tools are going to deliver, especially for individual creators, artists and creators and game designers, for example, that can create whole apps almost on their own. So that should, I think, if I was to advise the youth of today and graduates,
what do you tell the kids?
Is get unbelievably proficient with the new tools, immerse yourself in it, become native with it, and then leapfrog, whatever professional ladder you're trying to get onto, leapfrog the incumbent people on that with these new skills, which are...
And I don't disagree with that. As a matter of fact, this entire interface that you're looking at here for the higher standard was largely created with Claude Code, ChatGPT, and a couple different elements that we've pieced together. Now, of course, I had to come up with the aesthetic, the look, but the development of the server, the database, the hedge fund modeling, this was all worked through with AI in order to ensure that things were working as they should.
They're going to change the workplace, and I think there's going to be plenty of new opportunities anytime there's a lot of disruption.
And I don't necessarily disagree with that. I think that's probably a fair statement, but I think what he's missing is the human side of things, and let's talk that through a little bit, because I think it's important to kind of be clear here. Humans naturally are afraid, right? We're tribal, we're animals through and through, and because of this natural healthy fear of change, because we like to see things consistently, we don't like changing our behaviors, generally speaking, people are going to freak out as the layoffs start to pile up, and they will start to pile up. Sure, there will be opportunities on one side of the aisle, and people like me can make things like this that I normally would never be able to make without AI. But you're going to have a problem from a behavioral economics perspective, because the headlines will be the layoffs. It won't be on the jobs created, and frankly, most Americans won't understand those new jobs. So you're going to see negative headlines around jobs continue to creep up, particularly in a situation where the consumer is strained. You've got a disproportionate amount of the wealthy that are propping up gross domestic product, GDP, which is 70% lifted by consumer spending. If you talk to most of your friends in the middle class and in lower class, you're going to find that most of them aren't spending a whole hell of a lot of money relative to what they were years ago when they were getting stimulus checks and the overall market was flush with cash. So there is a bit of a divide there, which I think people are ignoring, intentionally or unintentionally as it may be. But I know you're saying, Chris, these are all words coming from you, and this is a proof of concept show. Do you have any proof of said concept? And of course I do. I'm anything but lazy when it comes to stuff like this. So let's get in. I think this will show well on the social side. Oh, no, we won't have to go screen. There we go. All right, there is your headline today. This from Yahoo Finance. Amazon is about to cut 14,000 corporate jobs ahead of its Q4 earnings report. You could argue this is not AI. You could argue a lot of things, but we're going to listen to this right now, and I'm gonna try to get this to work the right way. Last time I did this, the audio got a little weird, so let's see how it plays out. Okay, hold on one second.
Of October, there were layoffs. Reuters had reported then that they were looking at to cut a total of 30,000 jobs from the white collar workforce. And so now Reuters reporting that as early as next week, they'll make additional cuts to reach that number. They had previously cut 14,000 positions, so they still have a number to go before they reach that goal. And so we could see it as soon as next week. They report earnings on the 5th, and so we'll probably see them do the cuts and then give some kind of explanation as to where they were related to, or the reason for it was as part of the actual earnings call. The original thinking was that this was a result of AI, and then Andy Jassy, CEO, had said, kind of not really, on the earnings call, basically saying, that it wasn't even necessarily related to AI, but more of a culture issue. Well, these are the white collar.
More of a culture issue. Yeah, we're not looking at AI. No, why would it be AI? Because that would be a convenient and interesting narrative, wouldn't it be? Like, you gotta have thick skin when it comes to stuff like this, because you don't necessarily know what the real answers are. You just know how people feel, and well, that's the headline. That's the stock price, kids. Amazon.com Inc. up 2% today, $4.7, $4.70. That's your intraday trading. So they weren't hurt financially for it. And, well, if you want to go, okay, well, Chris, how have they done over the month? Well, let's take a look at the month. Yeah, didn't hurt them there. Let's go 1 year. Also didn't hurt them there. So I don't think this routine windfall of layoffs, and look, I think everybody knows. I'm not telling you anything you don't already know here, but let's have this dialogue. Amazon is very tech driven from an operational logistics perspective. They've got machines around their factories. We've all seen the pictures. We all know what that looks like. So don't be naive to think that AI isn't part of this conversation. Sure. Is some of the technology possibly coming from just overall improved logistics? Yeah, maybe. Maybe it is. Maybe it's not. But let's talk. Let's see what Uncle Jamie had to say. Uncle Jamie Dimon, I'm a big fan of Jamie Dimon, even when he gets sassy like he did in Davos this last time, which, respect to him for doing so. I think I actually kind of like it when leaders do this thing. I think that it's important. I hope this one displays a little bit better. Let me try this screen. There we go. This one displays a little better, a little more aesthetically pleasing. And what I'm going to do is I'm going to back this bad boy up here a little bit. And let's see here. Take the mute off. Let's refresh this bad boy. Let's play it. Let's see what we get. Or not. Come on. Oh, I got to do this thing again. Screen. There we go. This one displays. Yeah, that's where it's going to get weird. I can't. Maybe I can do this here.
How can you phase in AI?
Just tell them you can't lay off 2 million truckers tomorrow. You can phase it in over.
So you want the government to tell you can't lay off a whole bunch of people at JP Morgan?
And we would agree. If we have to do that to save society, remember, it'll be more productive society. So society will have more production. We're going to cure a lot of cancers. You're not going to slow it down. How do you have plans in place to make it work better if, in fact, it does something terrible? And that's the only way to do it.
And that should be done at the level of the government telling companies they cannot lay off?
No, I think it should be done at more of a local level, where someone says to a JP Morgan, we give you incentives to put in place to retrain these people. Can you slow this down and give people income assistance? Yeah, we could do stuff like that. We're not going to kill all of our employees tomorrow because of AI. So
wow. There's a lot to unpack there. So I guess he kind of argued for subsidies to not lay people off in situations like this, because he doesn't want to hurt people, but at the same time, he wants government subsidies to not hurt people while his company gets more efficient and more productive. it's a strange narrative there, and I love this chick. I don't know who she is. I've never seen her before in my life. This is the first time I've ever seen her interviewing people in Davos, and maybe I've just been disconnected or oblivious. But man, is she good? She's over here, you know. So you want the government to step in, and she also hit him with the look. You're basically telling me, in one hand, that you have an opinion when it affects J.P. Morgan, but you don't have an opinion when it's geopolitics. And he's been very pointed, and he caught her. I mean, admittedly, she was trying to get a soundbite from him, but I don't know that it was a soundbite as much. Ooh, package, please hold. See, still running a business, still getting things done. Don't let anybody tell you different. Okay, so yeah, I don't know that necessarily that Jamie Dimon did play into the soundbite request, but certainly she's trying to get a soundbite. She's trying to push and prod him and provoke him the right way, and I think she did that. I think that was an accomplishment on her part to get him to say things that I think that people really want to hear him say. They want to hear his opinion on these things. But of course, there was another moment at Davos where Uncle Jamie went, as I like to call him, full thug life. Yeah, and it got interesting to say the least. So I'm gonna go and play this for you, and I want you to see that. Like, I don't know if this was frustration on his part or just him being candid in a way that he had not been before. But well, let's play this a little bit here. Let's see how it goes.
Headline. I'm a globalist.
I'm not looking for a headline.
You know, I've been coming to Davos all these years and listening to chatter and stuff like that. He didn't do a particularly good job making the world a better place. I think it's great we get together and talk. But you want me to do this is.
I want you to answer my question. It's not
one
hard.
Headline that gets razzed up.
No, I don't.
A million different
Jamie, that's not true. I'm genuine. I've asked you this question off camera.
I've made it clear. I want a stronger NATO, a stronger Europe. Some of the things Trump has done are causing that. Some are not. I'm not a tariff guy, though I'd use it in the 8 cases I had. I think they should change their approach to immigration. I've said it. What the hell else do you want me to say?
Woo! Coming in hot. What the hell else do you want me to say? I mean, there's a lot I would love to hear you say, but I think that's frustration on some part. He's not thinking that the World Economic Forum, as sexy as it sounds, is really meaningfully changing the world and making it a better place. And make the world a better place for you and me. Yeah, it's not doing that. So let's go to the socials. I like to spend a little bit of time here every single show because it gives me the popular narrative. I typically use X and Instagram for this. Actually, before I do that, let's go to something. I want to show something to you guys I thought was interesting. This is the average time spent in-app, according to eMarketer, per user in the US per day. TikTok use in 2023 was 1 hour per user. Wow. It is now in 2026, granted, first month of the year, down to 50 minutes. Now, I know you're thinking, wait a minute, that's a 10-minute difference. Well, yeah, 10-minute difference is meaningful per user when they have millions and millions of users, right? Meanwhile, Instagram and Reels are continuing to blow up, has gone from 33 minutes per user up to 36 minutes per user. So what you're seeing is effectively 10 minutes going down this way to Instagram use. So Instagram use is picking up as TikTok use tends to subside a little bit. Now, I don't know if that's solely because TikTok was under scrutiny and I was a US buyer. There's a little bit of question as to the algorithm here. But certainly there's a shift going from TikTok to Instagram. The only difference is people selling on shops on TikTok seem to be doing really, really well. There's definitely a paradigm shift there. I think Whatnot owns that market in a much better fashion personally, but I do think you're going to see a little bit more of selling online in this fashion to be a little more public as time goes by. But meanwhile, let's look over here. John Brooks, December 2025, just printed the worst home buyer demand ever on record. The pending sales index collapsed to 71.8. That's 30% below normal and deteriorating fast. You don't get a strong 2026 with numbers like this. Rates aren't saving it. Incentives won't save it, referring to the builder incentives, which are actually giving you a net new home price below existing home sales. Think that through. New homes are selling on average less than existing homes that are older. So when you take out the incentives, only price discovery will. Now, I don't necessarily know that I agree with that sentiment, but you have to understand in this spectrum of things, the housing pundits get hyper aggressive, and they really, really fight. If you want to see people fight over housing and affordability, go to X. They go bonkers. That being said, this is from Reventure Consulting, not his company. You're at a record low. This is exactly what he's referring to down here. Pending home sales are coming down and coming down meaningfully. As a matter of fact, if you go back all the way to 2001 and you go all the way through here, even during the great financial crisis, pending home sales were not this low. Okay? That to me is a red flag. Where that goes, I don't know, but I certainly don't see rates improving. I see incremental small improvement on home prices. But again, for perspective, for every 1% in home prices, this is approximations, nobody get at me with some math, you need about 30 to 40% in some cases on home value drop to get the same type of affordability benefit. So really rates have the greater impact on affordability, which is in fact what this chart is supposed to show, is that the rates have a bigger impact on affordability than anybody thinks. And I was not that guy. I was a home price need to come down guy. I still am a home price need to come down guy, but that certainly is a chart which seems to express otherwise. Going back to the social narrative here, so you got an interesting pending home sales perspective. Let's go back to the social view here and do a little bit more scrolling. President Trump confirms that 0% income tax is coming very soon, where the money we're taking in is so enormous you won't even have to tax to pay, which I find to be an interesting narrative. And I'm gonna pause this and we'll play it and hear it out. It's only 12 seconds. Some of this stuff to me is fodder for feedback on social media. I don't know that it's necessarily true, but this would be kind of cool if it were, right? Like, I mean, I'm down. Like, I'm sure you guys are too. Let's play it.
That at some point in the not too distant future, you won't even have income tax to pay, because the money we're taking in is so great, it's so enormous, that you're not going to have income tax to pay.
That'd be dope. I'm not gonna lie. Sign me up, President Trump. Sign me up. And I'm not advocating politically one way or the other, but that helps my wallet a great deal. I'm okay with that. But unless it's AI, in which case I'm sorry, I guess. All right, Binance founder CZ just explained how his first day was in prison. Come on, we got to listen to this. I don't even want to play it, but I'm for 30 seconds of how his first day was in prison. It's worth it. Let's do this. This is gonna be good. I can already tell. All right, CZ, give it to me.
Do you remember the first day?
Yeah, the first day was pretty brutal. So you go in, they strip search you, you strip naked, you show your hands, show your back, the back of your hands, show your ears, open your mouth, show your tongue, lift your balls, flip over, spread your butt cheeks, cough 3 times.
Oh my God.
And how did you deal with that emotionally?
I'm not usually very emotionally stable. So I just thought, at 4 months, I just got to get through it. Right, so you won't be fun, but I'll just get through it. So I was like, okay, this is just another day. Yeah.
And did you remember the first day?
Wow, I did not expect the level of color we got. Wow. Okay, well, this is why we share stuff on the show live, because you get some live reactions. Jay Parsons in the housing market. Here are 20 markets where current apartment renters may have real bargaining power when renewing their leases. That's because of something in the industry calls gain to lease, which results from high supply putting downward pressure on rents for new renters first, and then filters down to current renters. Short version, new leases, lease rents, new renters surge faster than renewal leases. Yes, but the problem with this is this data suggests that these things are happening in real time. But generally speaking, and let's go to the full screen view here. Maybe I can pull this up and you guys can see it. It is very narrow font. This is the 3-year averages apartments new lease trade out versus rental lease out trades. It doesn't give me a time span here. Am I missing it? Yeah, it doesn't give me a time period. So Austin is obvious. That's the one down here. Tons of supply. You've got a huge housing correction that's happening there. Almost a crash, frankly, if you will, based on the data. Remember, 20% or more is crash under the technical definition. But you got Raleigh, Jacksonville, San Antonio, Phoenix, Atlanta, Las Vegas, Denver, Orlando, Nashville, Dallas, Charlotte, Tampa, Salt Lake City, Fort Worth, Oakland, Houston, Seattle, Portland, and Minneapolis in that order, frankly. So I don't know, and this is normal, right? So you have an excess of housing supply, housing correction coming through. You're going to see rental rates come down because people don't want to pay what they would pay for a mortgage for rent, and that's kind of the juxtaposition of the market. There's a little bit more of a technical definition, but for the purposes of this conversation, I think you get the point. So you'll see some rental improvement here. Bitcoin and crypto market structure bill will pass very soon, according to the financial committee chairman. Yeah. Breaking news: margin financing in China is up to a record 390 billion. Yeah, and that's interesting too. So we just had the Japanese bond market turmoil, and I generally do not cover international stuff unless I think it's going to impact the U.S. markets. I think this very well could. If everybody out there is borrowing on margin, you've got set up for potential collapse again. I'm not a China expert, so I'll leave it there. It's one of those things that I'll watch for some period of time. Well, look, let's lead into the weekend. Let's have a good one. I don't want to dwell on the negativity in the headlines. It is relatively an uneventful day, frankly, and I think that is a good thing. If you have an unsexy day in the stock market, that's usually a good sign that the market isn't struggling a whole hell of a lot. Now, I will admit I'm saying that while this is happening in real time. Again, I wouldn't freak out. It's just risk off. It's narrowly into liquidation mode. I think the markets are just shifting that way a little bit, but not a huge scare in my mind. What's a bigger concern to me is the Fed and the meeting next week. So let's go back to our calendar view here. You got the FOMC rate decision press conference, all that happening right down there. And I think that's an important perspective to keep. I'm actually going to take a screenshot of this bad boy later on. One of the things I like to do after the show is recap all the tech and see how I can make things better. I think moving forward, I'm going to fill in the data here. But all eyes next Wednesday on the FOMC rate decision. For those of you who have watched our previous shows, we are going to cover that live. We are going to cover it with our new format here, as opposed to how we used to do it historically, where it was basically just me and a big screen of CNBC. And I am going to keep a way to do real-time tracking of X. So what I'm thinking is probably when you see me next week is we'll have, them here on the screen like this. You'll have one of me and then possibly an X feed there or something to that effect. I'll figure out the layout and structure of it, but hopefully it'll go really well. Let's go to the chat for a little bit. I didn't spend a lot of time talking to a lot of people today. Let's see here. Danny Pants. I couldn't really understand Jamie Dimon's explanation. I think that's intentional. That's Scott Bennett. It's definitely affected the entire level of software engineering. Yeah, this is actually a really interesting thing. It's definitely affected the entry-level software engineering job market. There are way less entry-level jobs than normal. Yeah, I think that's going to be the case. And I think that for people like, DeepSeek's CEO to say that it's not really visible yet, that's crazy. I mean, I hear you. I see that kind of stuff too. I don't see how people could ignore that, and it's kind of strange. Let's go to Danny Pants. I couldn't really understand Jamie Dimon's explanation. Yeah, and I think that's by design. I think in some ways he's caught himself in a situation where he said something he probably shouldn't have said, and he was feisty anyway. But the long story short is I think he's trying to argue for government subsidies to companies to not lay people off, whereas they buffer FTE employment, which makes no sense whatsoever unless companies are getting paid more than the cost of keeping the FTE. But then why would the government be subsidizing that? So yeah, his explanation really didn't make a whole hell of a lot of sense. And Saied, to your point, I need more uneventful days. Yeah, me too. As a matter of fact, the biggest news that I've seen so far outside of sassy commentary in Davos, today at least anyway, has been the weather. So yeah, that's a real thing. And let's go over to the Instagram chat. What up, Instagram? How you guys doing? Let's see here. I've worked with streamers. A 2% increase in time per day for users is massively a win. 10 minutes is insanity. Success for the platform. Yeah, I think that's probably true. One of the things I don't know is I don't have that experience, so I couldn't tell you from my experience, Nathan, that's meaningful. But it looked meaningful to me because you start thinking about the millions of users on the platform, and that even 1 minute increments can really change things dynamically. So, all right, everybody. I think we're going to call it a wrap today. Good, healthy day in the markets. Everything looks relatively okay. Let's take one little quick snapshot at the markets to see where we're at here. We got a forced selling liquidation in the markets leading into the FOMC meeting. We got a synthetic volatility index. The fear in the markets appears to be relatively calm. So that forced selling is not fear-driven. It is driven because of what they expect to happen next week or not to happen next week, i.e. rate cut. You've got a restrictive Fed where we're showing a little bit of a tense/restrictive policy where the Fed balance sheet's flooded with cash, but the reverse repo line, the Treasury accounts seem to have spent a little bit more than they're making right about now. And of course, you've got a calendar of events which shows you that the FOMC meeting is next week. 97% probability that there will not be a rate cut, according to Chicago Mercantile Exchange. And home affordability remains to be strained. And as interest rates rise, as the 10-year sell-off continues, you wind up having Treasury rates push the mortgage rates higher. This is expected to get worse before it gets better. And certainly, you're not going to see a whole lot of relief as a result of the Fed meeting next week. Thank you, everyone, for tuning in. We will catch you next week. Check out episode 319. Saied and I actually do a full review of Davos with commentary back and forth with some world leaders, which I think is really cool to share. Until next time, my friends, okay, as Saied would say, bye.